When buying, selling, or refinancing a home, closing costs are the fees associated with the closing of the transaction. Since the financial crisis, the costs to originate a mortgage have increased substantially, and these fees are passed on to borrowers in the form of closing costs or, in many cases, higher interest rates. The main reason for the increases are related to compliance efforts designed to protect both lenders and borrowers from unscrupulous behaviors from either party. Fees vary from state to state, but typical fees a borrower may encounter when closing a mortgage include origination, processing, underwriting, credit report, flood certifications, appraisal, attorney fees, pest inspections, title insurance, title search, closing protection letters and other title-related charges, deed recordings, survey, closing, and other mortgage-related taxes or fees. While these are an example of the typical fees a borrower may see detailed on their loan estimate, it is by no means meant to be a comprehensive list. There are many additional costs a lender incurs when processing a mortgage, and many times these costs are bundled into what may be referred to as the processing fee or the loan origination fee. Some lenders may choose to simply list a bulk fee, while others choose to break them all out. Other typical costs a lender incurs include fraud prevention reports, tax transcripts, credit report supplements, credit report scoring fees, employment verifications, rent verifications, homeowners association, and many others. The cost to originate a mortgage can vary significantly from city to city or state to state. Many states or local jurisdictions have taxes or fees that others don't. There are also other costs associated with purchasing or refinancing a home that are not considered closing costs, but a borrower should still account for. The most common are what are referred to as prepaids. Prepaids include property taxes, homeowners insurance, and interest charges from the date of settlement through the end of the month in which a mortgage loan is closed. An escrow or impound account is established to pay property taxes and homeowners insurance, and money is collected from the borrower at closing to fund the account. By law, an escrow account can contain a 60-day cushion, and this is accounted for at closing. This cushion helps to ensure that there's enough money in the escrow account when property tax bills are paid or when homeowners insurance bills are paid in case they went up the previous year. An annual audit of the escrow account will ensure that it never contains more than a 2-month cushion. Mortgage interest is always paid in arrears. Let's say you purchase a home and close on July 15th. At closing, your lender will collect interest from you from that date through the end of the month. In this example, since there are 31 days in July, the lender would collect 16 days of prepaid interest. The first mortgage payment will be due on September 1st, which covers the interest due for the month of August. There are many other fees a borrower may encounter at closing that are not lender-related and therefore are not considered closing costs. Common examples include fees related to homeowners associations or other taxes or assessments, realtor fees, inspections, or repairs done prior to closing. In a purchase transaction, the closing costs and prepaids may be paid by the borrower or the seller. If paid by the seller, the real estate contract is written so that the seller agrees to contribute a specific dollar amount and credit it to the buyer out of the purchase price to cover the closing costs or prepaids. The amount a seller can contribute towards closing costs and prepaids varies based on loan program and down payment, so be sure to inquire your prime lending loan officer based on your transaction. In a refinance transaction, the closing costs are typically built into the new loan using the home's equity to pay them. A borrower may also choose to pay them out of pocket when refinancing to lower the amount being refinanced. Closing costs may also be covered by the lender in many cases. Depending on the loan size and the total of closing costs, a lender may be able to increase the interest rate and then take the additional money earned from the above market rate and credit it back to the borrower to pay some or all of the closing costs and prepaids. Appraisal fees vary based on loan type, number of units, and occupancy. Title insurance fees are based on the loan amount, as are mortgage tax-related fees, so they will vary. And the amount of prepaid interest collected at closing varies based on the loan amount and the date of the transaction. A breakdown including all closing costs associated with your mortgage is disclosed to you in a document called a loan estimate, or LE for short. For more information on closing costs, please reach out to your prime lending loan officer.